One of the most commonly misunderstood terms and concepts in the world of numbers and accounts is depreciation. It's even misunderstood amongst accountants. And in this video, I'm going to explain what depreciation is, why it's relevant, why it's not relevant in some occasions. Let's crack on with the video. Now, depreciation, as I said, is a concept used in accounting that is often misunderstood, even dare I say, by some accountants. And in this week's video, I'm going to expand on that theme, highlighting what depreciation is and what it isn't, its importance, its calculation methodology, and when we can disregard it and why we bother in the first place. Now, firstly, what is the relevance of depreciation? Well, depreciation is used to help us apply the matching concept or accruals accounting that was covered in last week's video. Now, the idea is that when an organisation and a business generates revenue, it needs to compare and match the expenses in doing so. And depreciation helps us with that concept and give an insight into accounting reality. If we dive deeper into what depreciation is used for, well, depreciation is something that's applied to particular types of items. So in our business, we have certain items that we might collectively call capital items or fixed assets if you prefer. So for example, in the case of a restaurateur, a restaurant is going to have ovens, fridges, tables. Now those items are going to be extending their use beyond the current financial year. The intention behind the owner when they acquire those items is to use them to support the business, give diners somewhere to sit, and help generate economic benefits. If we change the environment and we go to, say, a theatre will have stage set, lighting, sound equipment, etc. Now, the purpose of those items is to enhance the audience experience, to help with the productions, and they're going to be intended to be used for a period of time beyond the current financial year. Even for a service-based business may have computer equipment, slide presentation equipment. Again, those fit the criteria of capital or fixed assets. Now, we incur the expenditure today, so you spend, for example, £20,000 on buying a piece of equipment. Well, if that use is going to extend beyond a financial year, it's going to be unfair just to offset it in one financial year. You're going to have a distorted view of profit. Now, let's continue. And I think it's important at this stage to emphasise what depreciation is not. Now, many people mistakenly think that depreciation is used because items, capital items, lose value. It has nothing to do with that whatsoever. Depreciation is merely an allocation exercise. Sounds grandiose, doesn't it? So if we think I buy an item and I spend £20,000 on acquiring it, but that item is intended to be used for, say, a 4-year period, all I'm going to be doing is to spread that cost over the next 4 years. Now, carry on listening and carry on watching, because I'm going to explain the methodologies that are open to financial people to apply that concept. So if you think about certain items, most items, yes, they do drop in value. You buy a car, you buy a computer, it tends to drop in value over a period of time. However, that's not the rationale behind depreciation. If you consider a building, if you own a building to either house your staff, to operate your business from, well, that building may actually maintain its value. If anything, if property prices are anything to go by, in general terms, it goes up in value. However, we still depreciate buildings. So dispel that notion that depreciation is because items drop in value. It's not completely irrelevant, but mostly so. So what have we learned so far? We've learned depreciation helps us apply the matching concept, and it helps us give a more accurate perspective on what profitability actually is. Secondly, it applies to capital items or fixed assets if you prefer. Thirdly, we spread that cost over a period of time. Now let's continue. Now when it comes to how do we spread the cost, in the accountants in the numbers toolkit, you've got a variety of ways to actually achieve that objective. Two of the most common techniques that are adopted are called the straight line basis, there's a term for you, and something called the reducing balance basis. And let me illustrate those two techniques. So let's assume the item that I've bought I run a theatre company, and let's say I spent £20,000 on lighting stage equipment. I'm intending to use that for quite a number of productions, and my intention is not to sell that on to somebody, but to retain that in my business. I sit down and I think, okay, I take the item that's cost me 20 grand. I expect it to last a 4-year period before it becomes depleted and it becomes uneconomic to use, and I need to replace that. I assume also that the item at the end of its 4-year life has no what's called scrap or residual value. So what I'll do, I'll take the £20,000 and I'll spread that equally over the next 4 years. So each year, £5,000, that's 20 divided by 4, will be charged or offset or allocated in calculating the profit of my organisation. Now, alternatively, I might take the view that the item has more benefit to me in the early stages of its life. It may be such that as time goes on, the cost of repairing and maintaining that item becomes heavier. Therefore, it might be thought that actually I should be allocating larger amounts of that capital cost in the early stages and smaller amounts in the latter part of its life. So, applying reducing balance, I might be saying something like £6,000 is charged in year 1, £5,000 is charged in year 2, that's 11,000 so far. I'm going to charge maybe another 4.5 in the 3rd year, and the balance will be in the final year. Now, the actual numbers themselves don't matter for this illustration, but it says I'm charging larger amounts in the 1st year, smaller amounts in the latter year, and if the repair bills tend to also increase, it's a more fairer, equitable way of doing it. There are other techniques, by the way, available to you, but that's just giving you a flavour that accountants, generally speaking, have judgment and freedom to choose the one that's most appropriate. Quite common in organisations that you might have different methodologies for different types of assets. Now, what else? When can we disregard it? Now, depreciation is a useful number, certainly. It's certainly used to calculating the profit, the surplus or deficit that we generate from our businesses. However, where it loses relevance is when we actually look at the underlying performance of the organisation in terms of, for example, cash flow. Now, if you're preparing a cash flow forecast, which I thoroughly recommend, and please do check out the notes for Budget Whiz, our online financial planning tool, which is going to liberate your time and help you in your business, then depreciation is an item that's completely disregarded. It doesn't appear in your bank statement, it doesn't affect the cash flow, and therefore it should be disregarded. Organisations should be looking at the underlying value, the underlying cash that's generated from their organisations. One last thing to conclude, folks, when it comes to depreciation. Now, we have 2 main financial statements. We have something called a profit and loss, or income and expenditure, or SOFA if you're in the charity sector. Well, depreciation appears in there on the annual charge that we do. We can also display that in our management accounts. We have a secondary statement called a balance sheet, and it's a bit like a seesaw. So we itemise the items of value, the assets, and we also include all the debt and the liabilities of the organisation. So as time goes on, our £20,000 item will be recorded in our balance sheet, and as each year goes by, we're going to reduce it by the total depreciation we've charged. Now, in the accounting world, we show those assets at book value. Now, I'm going to be talking about balance sheets and financial statements in future videos, but that's just giving you a flavour. Now, in conclusion, depreciation may seem something abstract, it may seem a very arcane accounting concept, but it's really critical and is here to stay to help organisations understand the overall profitability that we are generating in business. It has a relevance, it reinforces to somebody that an asset has a cost to the organisation. We obviously offset the repairs, but we also need to allocate depreciation. And lastly, remember, it is not a measure of the item losing value. It's purely a cost allocation exercise. Obviously, if items do lose value to negligible, we may take that into consideration. So folks, I'd love to know what you thought of the video. Give me your feedback, I'd love to hear your thoughts. And until next time, happy depreciating.